Hello, everyone. Just give us a minute as we let the final set of folks from the waiting room in. Thank you all for joining us. I'm Karthik Ramanna, and together with my colleague Bob Kaplan, co-founder of the E-Liability Institute and co-authors on the original E-Liability paper, which was published in November 2021. We're absolutely delighted to welcome you all to this, which is our third e-liability conference. We had the first one in London as part of London Climate Action Week 2 years ago, and we had the second conference in Hamburg in collaboration with the Deutsche Bundesbank and several other central banks earlier this year. And this is now our third conference, and in part driven by the rapid advances in adoption, pilot studies, and underlying intellectual content on e-liabilities, which we'd love to share with you in this forum. So in a moment, I'm going to turn it over to Lauren, who is our Chief of Staff here at the E-Liability Institute, and she's going to walk you through a few of the logistics and rules of the road for this conference. We have a good number of people signed up for the conference, and so we are, notwithstanding the number of signups, we are not running this in a webinar format. We're running it in an open format, very much because the E-Liability Institute is a learning organization, and Bob and I run these conferences as much because we want to learn from you as we want you to be able to learn from the things that we've been able to publish on in the last few years. So let me also just say a word or two about the E-Liability Institute and the underlying e-liability method. Some of you are, of course, intimately familiar with the method. You might have piloted the method yourself. You might be professors who are teaching the method. You might be auditors who are looking at implementing the method. But some of you might be completely new to the method, and for whom this is effectively a sort of a first exposure to the topic. So we thought we'll just spend a minute or two bringing everybody up to speed on the underlying objectives of the e-liability method, as well as of the E-Liability Institute. So if we could just quickly advance to that next slide, Lauren. I think it's useful for us to start with the question, what is the problem that we are trying to solve? And very simply, the problem we're trying to solve is, how can an organization identify specific actions to decarbonize its outputs so that it can differentiate those outputs from those of its competitors or those from other organizations that might be supplying comparable outputs in the marketplace? And what we mean by that is we want to be able to accurately calculate the embedded emissions in any product or service that transacts in as close to real time as possible across the economy. So whether it is this iPhone that I'm holding in my hand, which will have some sort of embedded carbon associated with producing it, or whether it is these next 3 hours that we spend together on this Teams call, any product or service will have embedded emissions to them. These will be all of the emissions incurred by the direct producer or supplier of that product, but also the emissions incurred further upstream in the value chain. So emissions incurred by suppliers, etc. So how do we calculate these embedded emissions in a way that is accurate and verifiable? There's a related part of this, which is accountability for downstream emissions, which is also part of our intellectual and pragmatic interests here at the Liability Institute. And in fact, we're going to speak to that in one of our upcoming papers. But the idea and the comparative advantage of the e-liability approach is decarbonization by understanding specific embedded emissions in products and services at the level of batches, at the level of units of inventory of companies. And it doesn't have to just be for-profit companies. It can be government organizations, not-for-profits. Later today, we're going to hear from the amazing team at Oxford University Hospitals. That is one of the organizations that has run an e-liability pilot as well. So that's what the e-liability method and the underlying e-liability approach is. It's about leveraging the power and the strength of accounting to solve this really urgent problem for humanity, which is decarbonizing the planet. But doing it in a way that is technologically agnostic and ideologically neutral. The power of great accounting is that it is consistent with the first law of thermodynamics. And when you add up the accounting across all of the emissions in a supply chain or in a value chain, it will add up to the total emissions that we put into the planet in a given reporting period. That's one of the strengths of using a rigorous accounting approach to solve this problem. Let me also say a quick word about the e-Liability Institute. The Institute is a not-for-profit institute. It's a 501c3, which is to say that we don't have any commercial interest or incentive here. Everything that Bob and I do is intended for publication open source in the public domain. We post it usually on SSRN, which is the Social Science Research Network, for free for anyone in the world to be able to download. And we're doing this because we think that this is urgent and important, and because we might have some comparative advantage in addressing the problem. We have no commercial stake in the output. And neither Bob nor I are compensated for any of this work by the e-Liability Institute, given that it is a not-for-profit and we are members of the board of directors of the e-Liability Institute. Of course, since we are not-for-profit, it would be remiss for me as the principal investigator not to say that if you're interested in supporting our work in any way, then please do contact us at info@e-liability.institute. And with that brief introduction, I'm going to turn it over to Lauren Holloway, our magnificent chief of staff, to lead you through some housekeeping before our first session. Lauren, take it away.
Terrific. Thank you so much, Karthik. And it's so wonderful to see so many of you on the call today. I would love to get a sense of where everyone is dialing in from. Chloe, if you want to launch that poll, we're going to have a few polls dotted through the conference today, and we're really eager for your engagement on those. So while that's happening in the background, I'll run through some housekeeping details quickly to help keep things running smoothly at today's webinar and ensure everyone has a great experience. So to help minimize background noise and ensure that everyone can hear the speakers, we ask you to please keep your microphone muted unless you're called upon to actively speak. But we would love you to keep your camera on if possible. It helps make the session much more engaging and allows us to really feel connected to you during the conference. It's entirely optional, but seeing everyone's faces certainly adds to the interactive nature of these discussions. If you'd like to ask a question at any point during the sessions, and we will have some time for designated audience Q&A, you're welcome to please use the raise hand feature, which you will see in the top bar by your Teams screen. So this signals to us that you'd like to contribute, and our moderators will aim to address your questions during the Q&A. So again, that raise hand button is at the top. And if you're having any technical difficulties, just please post it in the chat and Chloe and I can assist. And a quick reminder that this conference is being recorded, and the recording will be shared after the event on our website and YouTube page. So if you miss anything or want to revisit a particular session or share with a colleague who wasn't able to dial in, you'll have access to that later. So it's a 3-hour conference. We've planned 2 short breaks, one after the first session and one after the second session, to give everyone a chance to stretch and recharge. We'll announce the breaks when the time comes, so feel free to step away for a few minutes and then return when we resume. And again, if you run into any technical difficulties during the conference, please feel free to use the chat to contact Chloe or myself, or contact us at the email on the screen there, conference@eliability.institute. We do ask that you reserve the chat for technical questions only. If you have substantive questions, again, please use the raise hand function or email us after the conference, and we'll be absolutely happy to assist. So thanks very much for bearing with me on those housekeeping details. And now it's my pleasure to introduce our first substantive session, which will be moderated by the formidable Alicia Seiger. So Alicia is a lecturer at Stanford Law School and leads sustainability and energy initiatives at faculties across Stanford. So she brings a wealth of experience, having advised the governance of California and New York, as well as numerous pension funds and family offices on climate risk and resilience strategies. And Alicia serves on the boards of Ceres and the Prime Coalition and co-founded the Stanford Professionals in Energy. And she's also a valued member of our board here at the E-Liability Institute. So with a career spanning over 2 decades, Alicia has designed and executed climate and energy strategies for businesses, investors, and NGOs. So we're incredibly fortunate to have her moderating this first session on the latest developments in the e-ledgers framework. So without further ado, I'll now hand it over to you, Alicia, to kick off the discussion. Welcome.
Thank you, Lauren. Thanks for that nice introduction. And thank you all for joining us. It's this morning here for me in California, and I see we're almost at 100 here live, which is really exciting. So looking forward to the conversation. This session is going to cover the latest developments in the e-ledgers framework. We're going to walk through 2 new conceptual updates. The first on downstream emissions reporting, including the differences between accounting and disclosures. And then we'll cover the link to LCAs and the recursive principle, which is so critical here for improving carbon accounts. So Bob and Karthik are going to speak to each of these. I will ask some questions, and as we've discussed, I'll be moderating a Q&A, so please do use the raised hand function. So to get started, we're going to first turn to Bob, who we're not going to read everybody's bios again, that they're available in the QR code, but I just want to note that Professor Kaplan was a co-developer of both the activity-based costing and balanced scorecard. So lots of experience here in innovative frameworks in accounting. So Bob, can you talk to us about, when you wrote the first paper, you and Karthik wrote your first paper, as Karthik mentioned, in November of 2021, you treated only upstream emissions, those coming from companies' supplier base. And the paper ignored, or at least didn't address, downstream emissions, even though that is the focus of the Greenhouse Gas Protocol's Scope 3 requirement for companies to report both upstream and downstream emissions. Why did you make that choice?
There were several reasons, Alicia. But when we felt that the Greenhouse Gas Protocol Scope 3, which treated upstream and downstream emissions equally, symmetrically, didn't make really full sense to us. First, companies can control their upstream emissions through their product design decisions and their sourcing and transportation decisions on incoming goods and services. But they have virtually no control of how their customers or their customers' customers use their product and generate emissions when using their product. And the idea that we're going to have a mining company or a plantation be accountable for the emissions in an airplane or a food product that's 8 tiers away from them didn't seem to serve any useful purpose. Whereas making them accountable for the minerals or agricultural products that went in the products that they purchased, that's something that they could influence. Second, the downstream emissions of a company are going to be picked up by the e-liability method. It's just baked into our method that if a customer downstream generates emissions when using a supplier's product, it will record those emissions. So we're already accounting for that with the e-liability method. And we didn't have to think about it twice by having an upstream company estimate what was happening downstream. Third, upstream emissions have already occurred. By the time they show up at a company, these emissions have occurred, they're in the past. This is where accounting plays a very useful role. They're objective, they're measurable, and companies can be accountable for them because they've occurred. Downstream emissions are kind of subjective, they're based on estimates of what might happen in the future, not a good foundation for accounting. But finally, the fourth reason was we actually had a solution for supplier emissions and measuring cradle-to-gate solutions. We didn't have a solution for downstream emissions for reasons that I just described. We're engineers. We don't want the best to be the enemy of the good. We felt if we had a really good solution that was implementable, verifiable, accurate, let's publish that solution and not get involved in speculating about what might happen with downstream emissions.
So that all makes very good sense. But then 2 years later, you indeed decided to write a paper about downstream emissions, which was published this summer in HBR. So what changed?
Well, downstream emissions just didn't go away. we kept hearing about them from not just people who were critiquing our approach, and there were several of those. They said, oh my God, by ignoring downstream emissions, you're letting fossil fuel companies off the hook, and which was not our intent at all. I gave you the reasons why we didn't do it, but even our friends and many of you on this conference today would ask us questions about it. And we felt, oh, there must be something here that's bugging people that we haven't fully addressed. What is it? And that we decided a year ago to go into this and try to identify, is there a role for some type of reporting for a company's downstream emissions? And we actually did find it. And that was the subject of the paper that was published this summer, July HBR. And we found for most companies, companies that are selling to other companies, they don't have any downstream reporting requirements. That's already picked up by the e-liability method. But where the gap is, and this is what was bugging people, was that when there are some consumers use a product and generate emissions, we don't have the e-liability method applied to consumers. We did not think it was feasible or realistic to expect e-liability reports from 8 billion of the world's consumers describing what happens when they drive their automobiles or heat or air condition their home. So it seems to me what was missing from our work until this time was for B2C companies that are selling to consumers. But not all B2C companies, okay? Companies that sell me a book to read, I'm not generating emissions when I read a book, so they don't have to worry about that. So it's only for B2C companies that actually, when consumers use the product, are generating emissions. And this could be driving an automobile, heating up food, and heating or air conditioning our homes. And the third is now, we don't expect a car dealer to be responsible for the emissions that I generate when I'm driving the car I buy from them. I mean, they had no influence about anything to do with the car. They were just an intermediary that enabled it to get from the manufacturer to me, the consumer. But if we go a little bit upstream from the car dealer to the car producer, a BMW, a Toyota, Volvo, they made a lot of decisions that influence the emissions I generate when I use their product. What kind of engine they use, the fuel efficiency when driving that, and the like. And so there's this causal link between decisions that those companies made about the product design and sourcing of the materials and the emissions that I, as a consumer, generate. And so the examples of this, are consumer packaged goods that we have to heat up. You can influence, how much I have to heat them up and for how long. Companies that make washing machines or laundry detergents, determines how much energy is consumed when I use that product. And of course, automobiles, which are, combusting gasoline or diesel fuel. And as Karthik said earlier, people that are using artificial intelligence and chat GPT or playing video games all day, they're generating lots of emissions when they use that product. So it's a subset of all corporations that should be subject to some type of downstream emissions requirements, but not all companies.
That's great, and as we've sort of introduced this as two new conceptual developments, but people are also here to get down to brass tacks and understand, what do I do in my company? So can you help us understand what do you recommend for companies to actually report on their downstream emissions in light of this work?
Okay, so next slide, Chloe. So it turns out that even if a company can influence how many emissions that a consumer generates in use, they can't quite control all the quantity of time that the customer is using that product or service in their day-to-day operations. And so this took me back to a fundamental equation in cost accounting. If we want to know the cost of materials, we need to know the price per unit of use of the materials. times the quantity of materials that goes into my final product. So if I want to know the cost of labor, I need to know the price per hour of the labor multiplied by the quantity of labor needed to produce the product or the service. So this is our fundamental equation in cost accounting. It's embarrassingly simple. Physicists have had much more interesting equations for centuries, but cost accountants are kind of simple people, and this is about as good as we get. And so this is a fundamental cost equation. Next slide. And so if we generalize this to total emissions that a consumer uses when working with a product, the consumer's total emissions are the emissions per unit of use times how long they use it or how much they use it. And you can see the quantity of use of the consumer could be how many minutes of cooking time, how many times I wash clothes in a week, or I wash a given piece of clothing, how far do I drive, and how many hours do I spend using artificial intelligence or playing video games. And so that's the total emissions associated with consumer use. Next slide. And if you look at that above equation, next slide, Chloe, with the green dot. Okay, so companies, B2C companies, can influence the first term in that equation above that's now highlighted by that green rectangle through their design decisions and the components in the car. So a BMW, the aerodynamics of the car, what kind of engine they're using, which tires they're using, has some influence on the CO2 emissions per kilometer driven. But they don't control how many kilometers that you drive. So, I drive my little car, maybe 3,000 or 5,000 kilometers a year. But others, road warriors, they're driving 100,000 kilometers a year. And an automobile company can't tell people how many kilometers they should drive each year. So they can only influence the first term in this equation and not the second. And so we think that they should be able to disclose the intensity of carbon generated through consumer use, but not really get into the business of controlling or even trying to estimate how many hours of video game playing or how many washing machine cycles a consumer might actually have. A second part of this is these are still estimates. I mean, not all kilometers driven are the same. Some people accelerate quickly from stoplights and drive at very high speed. Others are kind of normal drivers. And so the intensity of use it differs, even for one of these products. So we're going to be using estimates because we're speculating about the future, not reporting on the past. This is the difference between accounting and disclosure. So we can speculate and estimate about the future emissions that consumers will generate based on our product, and so we can report that, and we can do better on it. Some of the detergent companies allow you to get your clothes very clean when you wash in cold water, so you don't have to heat the water up. Well, that's a big deal. That's a lot fewer emissions to get the clothes clean, the desired outcome, and they should get credit for that. Especially relative to other detergent companies that don't have that capability of getting the clothes clean when they're washed in cold water. So, but this is disclosure separate from our e-ledger accounting system. Final hit, Chloe. And the other aspect of disclosure is that when I drive my car, well, certainly the people who influence the emissions include the car company, but it also includes the petroleum company if it's an internal combustion engine. So they're accountable in that sense as well, or the tire company, because depending on the structural characteristics of the tire, I might get better mileage per unit of energy use. So now we're into the multiple counting business, which is okay. That's fine in disclosure. It's not fine in accounting sense. So I think this is the contents of our paper. So we now, I think, do have a very good practical framework for downstream disclosure, which we've outlined here, and filled the gap that we left 2 years ago when we published our paper only on measurement of greenhouse gas emissions in the supply chain in the companies and the company's own operations.
That's great. Super helpful and detailed. Just as a reminder to the audience, we're going to do a little Q&A here on the downstream piece before I turn to Karthik to talk about LCAs. Karthik, I see you went off mute. I had a couple questions here, but did you want to chime in while we wait for the audience to raise their hands?
Sure. Yeah. No, there's just one point that I wanted to underscore from Bob's discussion, which is this importance of the distinction between accounting and disclosure. And prior to the year 1935, we didn't have anything called generally accepted accounting principles, or GAAP. And up until that point, as hard as it is to believe, companies went about making up their own definitions of assets and revenues and liabilities, and they didn't even have to tell you what those definitions were. It was really a free-for-all, and partly that was implicating the stock market bubble and the crash in 1929. And so it was only during the Great Depression that we sort of came together and said, wouldn't it be a good idea if we had these things called accounting rules that standardize things like definitions of assets and liabilities, and standardize the rules for which we use the double entry bookkeeping system. And so what we've learned since then is that accounting is a necessary condition to the functioning of markets. It's not sufficient. You need, in addition to accounting, a robust disclosure framework that builds on it. And that's the part in the annual report, which is we often call the management discussion and analysis, which is more speculative and not audited to the same degree of And so part of what we're trying to say here is that you need both accounting and disclosure. But accounting is necessary. And if we don't have robust carbon accounting, then it will be
I think Karthik might be having some internet
Yes,
issues. Are you back there, Karthik? Yeah,
I'm back now, but I think
okay.
The key point around robust carbon accounting and the implication of disclosure was what I wanted to underscore. So I'll turn it back to you, Alicia.
Yeah, no, I think it's a really important point. And I've just, Chloe and Lauren, I'm not seeing any hands right now. I don't know if you can see things I can't see. So I want to turn, Bob, to start with two questions. Okay, I see a hand, so I'm going to make it just one. Can you help us just think through, there's now a raft of disclosure regulations around the world. I'm in here in California, there's SB 253 that's requiring companies over $1 billion to report upstream and downstream scope 3. You've got the SEC that drew a line before scope 3. ISSB has gone long. How do you think about the current regulatory environment and this framework and where we go from here?
Yeah, I think the regulations reflect that up until 2 years ago, the only standard setting agency or even disclosure setting agency was the Greenhouse Gas Protocol. And there's a problem to be solved, and that was the only solution around. And so a lot of those disclosure requirements reflect history. The way people used to think about this problem before e-ledgers and disclosure based on those came about. And so regulations can change as with innovation that goes along. Science doesn't change, okay? The science now of measuring supply chain emissions has been established, and I think that'll prove durable. And so we are giving the regulators a much firmer foundation of action, which really is to, begin to adopt the e-liability framework, and Karthik will be talking about that right after me here, because that is on a sound foundation, tracking the underlying science of carbon emissions and supply chains, be accountable and verifiable, and so that's going to be the compelling story. And so we expect and hope that the regulations will evolve and adapt to using this more scientific and more verifiable approach.
Great. Okay. Forgive my mispronunciation potentially, but is it Ivan? You want to go ahead?
Yes. Thank you very much. I was just wondering about this calculation of the downstream emissions, that we can only sort of affect the CO2 per unit of use, but there's also this longevity of the product, right? So producers of products should add more hours into or more kilometers into the products so that they become more durable and can be used for a longer time, right? So how do you sort of think about that?
No, I mean, that's a great point, and that has to be fleshed out. And I think that Thomas Becker, the supply officer at BMW, is maybe on the line. So let's use BMW, perhaps Toyota as examples of companies that build long-lived car. And so if the cycle of replacement of an automobile is 15 years rather than 10 years, either because of the inherent quality of the design and production, or in the case you described, that it's being driven 100,000 kilometers a year, not 5,000 kilometers a year. That's something you might estimate too, because of the number of cycles that you have over a consumer's lifetime is influenced by the quality of the design. So that would be an opportunity for disclosure, particularly of people that are making durable equipment that will be replaced, durable equipment used by consumers. And this would include things like washing machines and refrigerators and freezers, that if they only have to be replaced once every 25 years rather than once every 5 years, then the consumer's emissions are lower. So that would be something we could put in a disclosure, like Karthik said, a management discussion and analysis of consumer-driven emissions when using our product.
That's great. And I'm Mike, forgive me, I'm going to skip over you because I see Thomas Becker is on the line and has his hand up. So Thomas, over to you.
Yeah, thank you. Just in addition to what Bob so rightly said, I mean, how do we handle this? Indeed, under SBTi, we disclose a carbon figure for the lifetime of our cars based on mileage. So we use as a basis the CO2 per unit of use. And then we say, as we have to, what we think with the assumed mileage will be the total footprint in the use phase. Now, coming to the question, we have an average number which is not exactly measured, but the most sound estimates that our vehicles live for roughly 21 years. That's above the industry average. But would we be able to say, okay, because of that, our impact on the environment is in a soundly measurable way better than the one of some of others? Or the impact of our cars has to be calculated differently than any other industrial product? I would really have a hard time to put forward that kind of a quantitative logic. In our case, this is aggravated by the fact that there is no real full statistics on the lifetime of vehicles. When a car is scrapped, people don't read out the mileage, etc., etc., etc. So I agree to the statement that we have a fundamental difference between what you could disclose according to agreed methods that acknowledge that it is not precise, and the accounting for the product as it leaves our factory. So maybe that's the perspective from the automotive side. Thank you, Bob.
That's great. Thank you. I see Mike's got his hand up. Mike, nice to see you. Give one more question here, and then I'm going to turn it over to Karthik. Please go ahead, Mike. You're muted still.
Hi, Alicia. Hi, everyone. Sorry about the muting. I wanted to press a bit further on who should disclose downstream. And let's go back to the BMW example, since we've been using it. So BMW manufactures cars, and then they are sold by dealers. And imagine a situation where a dealer is not exclusive to BMW, but carries a range of vehicles. And you certainly see that in more industrial use. So you have somebody who carries Caterpillar and Kubota and various kinds of equipment. The distributor makes choices about what vehicles they're going to sell. More relevantly, or more to the point, a grocery store makes choices about what agricultural products they're going to sell. So you could say, I'm going to be an all organic store, or I'm going to be an all low carbon store. So, how do you think about the responsibility of distributors to do disclosures, and how would you advise them about that? Because they do make some choices that make an impact. And in a parallel way, of course, financed emissions is another sort of indirect choice. The bank or a financial institution decides, are we going to invest in this heavy emission or this clean energy source? Those are also choices as well. So it's not the same as making the car, but it's arguable that they had some influence and some choice. So, Bob, I'd love to get your thinking about how we should think through those kind of, less obvious and a little bit more indirect kinds of sources.
Yeah, so our first pass at this is that it would be the supplier to the car dealership or the retail food store or department store that has the primary obligation for disclosure. And in fact, the intermediary, the distributor, really couldn't even begin to estimate what's happening from the products they sell if their suppliers did not give information about the potential consumer use of emissions. And the intermediary is not influencing the design of the product and its characteristics, which is generating the emissions. So at our first pass at this, we have excluded the intermediaries between the manufacturer, the automobile company or the consumer packaged goods company, and the consumer. Now, I suppose if they have the data, the kind of data we're talking about on this slide, then the intermediary is free to use that information in its own disclosure. It says, okay, the products that we have decided to market directly to consumers will have these characteristics in use by the consumers, but they don't influence the product design and production decisions that actually have the biggest impact on the emissions generated when consumers use the product. So I guess your question stimulates me to think that once we have full disclosure, are the estimated emissions as consumers use a product, then the retailer distributor could also use that information, package that up, and try to compete on the differential emissions used by consumers with the products that they have chosen to stock.
Great. Okay, in the interest of time, I want to turn now to the second conceptual development that we have to share with you, which is the link to LCAs and the recursive principle and its implications for improving carbon accounts. So Karthik, I turn it over to you for that.
Thank you, Alicia. And so this is a paper that has been co-authored with Niels Engel over at Katina X. And Michael Wang from the Argonne National Labs, where he's had a role in developing the GREET system, the GREET database system, which many of you will be familiar with, and with Maria Zuber over at MIT. And Maria is also, we're delighted to announce, the new chair of the board of the E-Liability Institute. Maria is also the co-chair of the President's Advisory Council on Science and Technology in the White House, and was a developer of the co-developer of the Sesame system, which many of you will be familiar with. So our co-authors on this panel or on this paper are quite familiar with LCA databases, and we thought we might work with them on this question of how do you operationalize the e-liability algorithm? How do you put the e-liability algorithm into play and rapidly scale up to the levels of accuracy that we need in order to drive decarbonization incentives in the economy? And of course, a real problem with any kind of implementation of this kind of algorithm is that supply chains for almost all products in the modern economy are codependent. And it's very hard to imagine a world where we can get all production worldwide to immediately commence primary emissions. the measurement of primary emissions, that is. Because, of course, there's going to be some sort of phase-in period. Some companies will be better at it than others. Some technologies will be better at measuring primary emissions than others. And so is there a way in which we can phase this in, is the question that we address in this paper. And the short answer is through a combination of the recursive principle and using existing major emissions data sources, such as ANL's GREET and MIT's Sesame, we think that there's actually a very plausible way forward, which if you then follow the work that our colleague Ulf over at the Deutsche Bundesbank has done, would suggest that under certain sort of not unreasonable assumptions, you might get convergence to the accuracy that we need in as little as 6 years. So that's really what we're getting at in this paper. So a key to making this work, and if we can just slip over to the next slide, Chloe, is the principle of recursion. And so what is recursion? Because we use this term recursion, we've used it since the original e-liability paper. It is a fairly technical term, so we thought it might be worth spending some time just unpacking what we mean by it. So at its heart, the problem that e-liability algorithms are trying to solve are seemingly, sort of infinitely complex. We're saying we need to estimate accurately in real time the embedded emissions of every product and service in the economy, whether it's this iPhone or whether it's these 3 hours we're spending together on Teams. And you're like, my God, but this iPhone is using materials that come from other materials that come from other materials, which in turn use iPhones to control those materials. So where do we even begin? So it's a seemingly insurmountable problem that we're trying to get at. And recursion offers a fairly sort of elegant way to solve this problem by breaking it down into subroutines, so that each time you solve the subroutine, you get iteratively closer to the outcome that you want to. And this is a critical improvement of the e-liability algorithm to almost every other, in fact, every other known GHG measurement approach out there, which is you can run, for instance, the protocol, the GHG protocol's approach to this, an infinite times, and it won't converge to an accurate number because it's not a recursive process. Likewise, even with LCAs, you can run them infinite times and they won't converge to a recursive number. But recursion allows you to run the e-liability algorithm over a certain number of iterations. And as a result of the recursive properties of e-liability, over time, they will converge to a level where we can get reasonably assured numbers. So in the first iteration, e-liability will be just as inaccurate as any other kind of measurement system out there, but over time, it gets progressively more accurate. So how would that work? Let's just skip to the next slide. And so in this next slide, we're looking at the example of trying to make in this case, a truck that gets sold to the end consumer. And that truck needs a certain amount of steel, and that steel comes from a sort of steel mill, and then that steel mill goes into the truck manufacturer who produces the truck that goes to the truck dealership. And of course, that steel in turn needs some metallurgical coal, and that metallurgical coal is mined, say, somewhere else, and then is shipped over to the steel factory, and then from there to the truck factory, and so forth. And one of the challenges we face here is that, of course, those very trucks that we're making at the end of this supply chain will be used in that mine, where the mine is, where the coal for that steel, which will then go into the truck, is made. So how do we calculate what are the emissions in that truck if we don't know what the emissions in the truck are, because the supply chain is circular? So in the first iteration of this problem, we just ignore the trucks used in the mine because we don't know what the emissions associated with the trucks in the mines are. Or we might be able to use reasonably comparable data from these existing databases like GREET. And I'll talk about that in a moment. But in that first iteration, we basically have inaccurate data. But at the end of that first iteration, and if you hit the next slide or the next button, Chloe, at the end of that iteration, you end up with data on the truck. And that data on the truck then can feed into the second iteration of this exercise, because now you know what is the emissions in the truck that you're using in the mine. And by knowing what are the emissions that you're using for the truck in the mine, you have slightly better data from the mining company, and you have slightly better data, therefore, down the value chain. And so the next iteration of having the truck dealership, the numbers of the truck dealership will be a little better. And then, of course, over time, as you add, and Chloe, if we can go to the next button, yeah, if you can add more and more suppliers into this mix at each stage in that supply chain, you get better and better data. So that's the principle of recursion working in this sort of successively or progressively improving way. So that, again, by the time you get to the 6th iteration, according to the stimulated data we've seen, you get numbers that are reasonably accurate, that is to say, within some sort of 95th percentile confidence interval to what might be the true underlying emissions, what we would say the true embedded emissions of that truck. So that's the recursive principle at work. But in addition to the recursive principle, and if we can move to the next slide, Chloe. Yeah, so if in addition to the recursive principle, we can also use data from existing databases like GREET, right? So when primary data doesn't exist, right, you can ignore that primary data if you say it's immaterial, but you can also use as a starting value some primary data that might be available, or some secondary data that might be available in a database like GREET. And of course, a key challenge for a company in using this data will be to find a sufficiently close proxy for what its output is from a database like GREET. And of course, another challenge is because many of these databases do cradle-to-grave estimation rather than cradle-to-gate estimation. And what we're really looking for is cradle-to-gate estimation, is to try disentangle that. But that's also possible based on what's available in some of these databases. So, but if you can draw on information from these databases, they provide you with starting values for this analysis. And again, because we're using the principle of recursion, each time you're running it, the process gets better. But importantly, the databases can become better as well. So if we go to the next slide, we'll see, well, what can the databases do to become better at this process? And to enable these recursive improvements, to basically turbocharge these recursive improvements, to make sure that they move faster and we converge in fewer cycles, what databases like GREET and Sesame and others can do is commit to progressively disaggregate the data they capture and report. So whereas in fact, if they are currently reporting average emissions per ton of grade 1A copper made in Sweden, we'd say that after the first iteration, they'll have some output from more specific units of analysis, and they can report data on grade 1A copper made from specific mines processed in a specific factory for a given month in Sweden. Now, that's a whole level of disaggregation better than the previous data that they made available. So if you work with the databases like GREET and Sesame, and of course, we're just using them because Michael Wang and Maria Zuber are our co-authors on this project, but you can use any kind of database that's out there. There are plenty of such database equivalents in Europe and the like. But if you use and work with these databases to progressively disaggregate the information that's recorded, you can get better information for the next iteration and better information for the iteration that follows that. So that actually accelerates the functioning of this recursive process by working with the databases. The databases can also make a progressive commitment to improving data quality. So this is where Katina X's work, and Niels, who is on our paper from Katina X, has explained to me how they have built this primary data score, or PDS, into Katina X. And the expectation is that the companies that are reporting their data on Katina X will over time increase the PDS, the primary data share, of the data that they put on the platform like Katina X, right? So one of the things that not just Katina X, GREET and others can do is disaggregate the data, but the other thing they can do is make sure that the data are consistently improving in quality, or at least not declining in quality. So databases can play a huge role, a very powerful role in driving the acceleration of this method. Now, it is going to be the case that some companies will treat their emissions data as proprietary, and they'll say, look, we don't want this data sitting on something like GREET because it's competitively sensitive information, and we want this information only to be available to our trusted customers. And that's fine too, because in situations like this, the data can be made available to a database like GREET. And the advantage of GREET, of course, is that it's a government database. It's not a commercial database, and so it has no profit incentive. It's part of the US Department of Energy. But you can make the data available to GREET under secure key. And all GREET needs to do is to calculate the next highest possible data aggregate for that data class and make that publicly available for everybody else in the economy. So your customers have access to accurate data, which is an advantage to them. They will be turbocharged in having better data sooner. But because that's something that you want to competitively differentiate on, you don't want disclosed widely, that's fine. GREET can aggregate it to the next level, and everybody else benefits from that aggregation. So this collaboration with databases like GREET and this investment by databases like GREET and Sesame in data quality can actually accelerate implementation of e-liability, but also ensure that public and private databases coexist. So that's the key message we want to leave people with in this paper, which is titled Accelerating the Implementation of Accurate Product-Level Carbon Accounting. And partly what is driving us to write this paper is an increasing interest in accurate product-level carbon accounting for purposes of CBAM, or the Carbon Border Adjustment Mechanisms. So CBAM is a reality in Europe and is increasingly going to become a reality in the United States, probably in other countries too, Australia, Canada, the UK, and I'd imagine that countries like China and India will follow very quickly. But of course, in order to make something like CBAM work, you need what is the equivalent of an assessment basis. You can't have taxes without a taxable basis. If you're going to have a carbon import tax, then you need a taxable basis. And you can't have the taxable basis based on industry averages and things like that, right? You can't use something like Scope 3 as a taxable basis because, you know, it's not designed for that kind of application. So you need an accounting solution, a proper accounting solution, and that's what this will enable us to do. But of course, what we need is to get to those kind of accurate numbers fairly quickly, which is why we've written this paper to show with the co-authorship team what's possible, even using existing infrastructure for implementation. So let me pause there, Alicia, and turn it back to you.
Oh, it's great. And you're saying increasing interest. I mean, I'm just noting we've got almost 130 people in a room here talking about carbon accounting around the world, which is amazing. Another 100 that have signed up to watch the recording, and I'm sure it will proliferate from there. So really a lot of interest. I also want to note, just time check, we're gonna give you the break at the top of the hour. So please do raise your hand if you have a question, but I'm gonna start while you get warmed up. This session has really covered these key differentiations of accounting versus disclosure, the recursive principle, which is so critical and such a key feature of the liability algorithm. But at the end of the day, I think, all these people here and who will tune in are quite familiar with the protocol. And there's a common comment that, oh, well, the protocol, there's a patch for the protocol that does this or does that. And so I think it would just be helpful, again, in sort of broader terms, and you started to go here at the end of your last comments, how is this really different, and what are the implications of that for practitioners and regulators of the liability algorithm versus the various patches that have been attached to the protocol over decades to try and address some of these questions that we're working on solving?
Right. So
and how do the two fit together? Yeah.
Yeah. And I see Bob's hand is up as well. So Bob, jump in on this after I'm done. So two things worth mentioning about that. Again, I think it goes back to the distinction between accounting and disclosure. I think it's somewhat unfortunate that the term carbon accounting has come to mean in common parlance what it means today, because that's not really just accounting. Accounting is a well understood, well developed body of knowledge that has a strong conceptual basis in hundreds of years. And it means certain things. Accounting data are mutually exclusive. Accounting data are collectively exhaustive. Accounting data are reliable. They're timely. They are specific, right? So they're fungible. Data that comes out of Scope 3 is not fungible. Even the Greenhouse Gas Protocol will tell you you can't add one company's Scope 3 to another company's Scope 3, or you can't use it to compare and so forth, right? So in that sense, what is done in that context is you can think of it as emissions measurement, but it's not carbon accounting. And as we said earlier, accounting is a necessary function to markets. It's not sufficient. You need a lot more than accounting for markets to work. But if you don't have accounting, markets fail. And we learned that in 1929. So that's really important in this context. And unless you have a rigorous bottom-up system that, you know, counts everything that's material and counts it only once, then you could, as many patches as you try to build on the existing disclosure system, you haven't solved the underlying problem. So that's what this has to do. So the second observation is, therefore, they don't have to be seen as mutually exclusive. They can be seen as a bedrock of accounting, which is used for things like CBAM, including sort of, you know, to create a carbon import tax, which is what jurisdictions are more interested in, et cetera. And then if you want to build a disclosure basis on top of that, then, you know, that's what you can use all of the work that has been done in the carbon measurement space to do that. But I think the longer we resist, because for whatever reason, you know, maybe sometimes because of inertia or whatever it might be, the longer we resist this distinction, the less likely that carbon markets will develop into the way in which we need them to develop to solve this most urgent problem, and the more likely we will lose the public's faith that this is actually making a difference. Because if you don't have accurate measurement and you allow companies basically to be performative in this exercise, which, I mean, you know, there's a reason why you can't have reasonable assurance of scope 3, then the public will eventually say, look, this is all a giant scam, which is what happened, by the way, in 1929. So it's really urgent that we work and important that we work on this together. Bob.
Thanks. That's so helpful.
So
Yeah, Bob, last word.
So let me just give a add-on or a somewhat different response here, is that what Karthik has described with the recursive principle is the transition path from greenhouse gas protocol scope 2 and scope 3 to a universal system of e-liability accounting. Greenhouse gas protocol, by their own admission, was developed as a voluntary system, which meant that a downstream company like BMW had to do all the heavy lifting. They had to do everything going upstream in its supply chain, and they also asked them to go downstream. And as Karthik said, in version 1.0, the first approach, we're going to use greenhouse scope 2 and scope 3 information, EPD type information. But in the next iteration, you know, we're going to get primary data from most carbon intensive suppliers, just the way you described it. And after 6 iterations, you don't need scope 2 or scope 3 anymore. The information is automatically being provided by your suppliers. And people ask, well, you know, how do you interact with the protocol? It's exactly what Karthik just described. For sure, in version 1, version 2, we're going to use a lot of that data, heavy lifting done, and estimation, not really accounting data yet, you know, from the downstream companies. But as we go through these 5 or 6 iterations, then we're going to get accurate, valid data from from all the organizations in our supply chain. And so the recursion principle is not a patch. It's the replacement at the end of the transition path as we move from a disclosure environment that Karthik described to the e-ledger accounting system. Now, is there a role for the protocol? Yes, because it gets back to my talk half an hour ago. You know, they can really work the downstream emissions estimation because that's disclosure. You know, we need, you know, try to do that for the subset of companies that, you know, it does make sense to have downstream disclosure. That's a useful role for them to play to try to refine that, respond to the question that Mike Mahoney asked, you know, what's the role of distributors and retailers? That's fine. But these cradle to gate emissions are going to be handled by e-liability accounting.
Wonderful. Thank you both, Bob and Karthik. Terrific session, very illuminating and enlightening.